30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Market had an interesting day today. The collective geopolitical sink was thrown at it. US equities down, gold and oil up, treasuries up, volatility up. The S&P fell through its 100-day moving average. So you've got to ask yourself what's going on. So joining me on the panel tonight is David Novak from Wealthwise Education and Michael Kadari from Kadari Securities. Guys, welcome to the program. The international focus is obviously on Syria as we speak tonight and what the response is going to be. So if we're heading down the track marked destination turmoil, is there anywhere really in the market that's a refuge at the moment?
Well, I think it's most likely crude oil, and gold seems to be the play, especially with the geopolitical tensions going on in the Middle East there. So crude oil could really burst up from here even further than it is right now. So looking at the trend right now, crude just touched 115 last night, and NYMEX crude was 110. So we could see, crude going much higher if the tensions get worse in the Middle East. So that's the main play right now, I think, is the gold and the oil sector.
Well, I mean, traditionally they've always been the two fallbacks, haven't they? Gold and oil.
Yeah.
In this day and age, are we still using what our grandfathers did, or is there somewhere else to go? Michael, what are your thoughts on that?
Well, I think from now till mid-October, the market will be volatile on the basis that the US, first of all, is running out of funds. In mid-October, it's going to decide if it's going to borrow more money. I think with what's happening within Syria, there will be a lot of volatility or uncertainty in the market, which might push some investors towards the gold market, as there's also a lot of bonds that have been pulled out of the market. So June was the biggest selling month for bonds, which I thought was very interesting.
Yeah, let's just talk about that tapering for a moment, because that is important, isn't it, David? I mean, with 9 days for Congress to actually do something about the debt ceiling, what's going to be the story?
Well, I was saying to you before the show, since they started the bond buying program in November last year, we've seen the 10-year rates go from 1.4 to a high of 2.9 last week. So, has the tapering really worked? Sure, it's added a lot of liquidity in the market, but can you imagine if they start removing the program, what will happen to the bond market? So I can't see they can afford to do that right now. I think, given the recent data that came out, just the durable goods order and the housing data last week.
The economy's in reasonable shape. It's not exactly robust, is it, from a US perspective?
Yeah, well, I'd debate that, actually. I don't know about, if I look at their debt and deficit, when they've got the debt ceiling limit, they've been pumping a lot of liquidity into the market since the GFC, and you've got still unemployment stubbornly high, although it's marginally come down. After you've pumped in about $4 trillion, you'd think that, that there'd be more bang for your buck, sort of thing. But they're still struggling in the jobs front, I think, and they really need jobs growth, which is what's not happening right now. And also, you've got this debate between the Republicans and the Democrats going on, and fighting over job.
Agree. Quick comment, Michael, on your wrap up, because we're getting to the end of the reporting season. It's only the dribs and drabs coming through, but your quick view on where the reporting season leaves us in terms of the corporate outlook for the next 12 months from Australia. What was your takeaway from it?
Look, I think the different sectors of the economy are very much weak. I think consumer confidence isn't there, business confidence isn't there. The mining resource sector will probably continue to suffer, and I think there should be a shift between portfolios from the reporting that came out.
What takeaways did you have from the reporting season in terms of overall levels of confidence about where earnings are going to be in 12 months' time?
Well, the general theme has been cost cutting. That's what I've seen. It hasn't been really top line revenue growth. It's been bottom line growth because of cost cutting. So going forward, it's a question of margins have been shrinking as well. I've noticed on a number of reports. So I think going forward, I just see a flat outlook personally, and I think at the moment I'm seeing a lot of valuations up here that look a bit stretched in my view. So I wouldn't be rushing out right now buying stocks. I'd be sitting on the sidelines. There's selective stocks I would, but you've got to be very selective. But I think at the moment it's probably a good time to sort of cash in a few chips.
All right, well, let's take our first caller who's got a question about one of those selective stocks for you, for both of you. Our next caller is Peter from Melbourne. Welcome to the program, Peter.
Thanks, Kim. How are you?
Not too bad, mate. What can we do for you?
I'm interested in buying some more or I'd like to buy some more CSL shares.
Yep.
I'm just wondering, do your panellists think they might come back a bit to enable me to do that? They're a bit high right now, perhaps.
Well, this is always a stock that's whenever you look at it, everyone's first comment is, "Geez, it's a bit high at the moment," or "It's a bit expensive." So CSL up in the sort of 64, 65 range, it always looks unstoppable, this stock. But is it running into some headwinds?
Oh well, I think so. I think it's getting pretty pricey up here on 25, 26 times earnings.
Yep.
Average growth over. This is the interesting thing about CSL. If you look at the average earnings growth over the last 3 years, it's been about 12%. But if you look at the share price performance over the last, say, 18 months, it's doubled. It's gone from about 32 to that recent high, about 69.
But this is the interesting point, Michael, that the market has been prepared to pay high multiples for high growth stocks, but yet there is a point in that cycle where those earnings do start to either plateau or slow down. And I get the sense we're starting to see that plateau or slow down starting to occur with some of these stocks, particularly in the pharmaceuticals and the healthcare sector. What are your thoughts?
Look, I think it's a great company. It's just at current price of 67.75. It's expensive. I think in terms of fair value, if you wanted to buy it cheap, probably you'd be buying it 15% below the current prices.
Where would you be if you were putting a buy on it, Dave? Where would you put a buy on it?
I'd probably put it back at $32 again. No.
Well, geez, if it gets back at $32, we can turn the lights out and go home.
Well, I'm just saying this has come back to the previous highs, okay?
Yeah.
And you've also got a bearish divergence I've got on my RSI indicator, which is saying warning. This is
for the uninitiated. You might like to just explain very quickly what an RSI indicator is, without all our eyes glazing over.
Well, it's called, for short it's RSI, but it stands for Relative Strength Index, and what it does is measures the average closing price, depending if you're looking at a weekly or daily chart, over the last 14 days. That's Wilder, who was the designer of it. So it looks at the average closing price versus the opening price. Okay, and when you see a deteriorating indicator at the bottom of the chart, which is where the RSI usually sits, and it starts to decline, it means that the actual internal strength of the move up in that stock is weakening. And it's always been quite a reliable indicator for me. So it's saying here, it's just flashing warnings up here, not to rush out and buy CSL right now. But look, if it pulled back, it got great support around that 64 level. That would be the level you'd be looking at, around the 64.
All right, so while we're talking about expensive stocks like CSL, what else falls into that category that you've come across?
Car sales.
Car sales, yeah. And what's
Brambles, I mean, not Brambles, sorry. Well, Brambles, I think, as well, but more so Boral, CSR.
Yep.
I mean, Boral come out with a net loss after write-offs, but even if you take into net profit before tax of, I think it was 104 million, they're trading on a 30 times earnings multiple on a 2.5% fully franked dividend yield. So, and they've given a guidance for the next year that in the construction sector in Australia, it's going to be flat. So, they are tied in somewhat to the housing market in the US.
Does realestate.com fall into that category along with car sales, or is that a...
Yeah, I'd put that in the same category as well. I think SEEK came out with a fantastic number.
Well, exactly, and we saw that. We saw that last week when James Packer sold, and the share price has gone up $1 or so since then. That very rarely happens when he sells something. But Michael, what are you seeing that's also expensive?
Look, I think most of the online companies like car sales, Flight Centre, good businesses, but are they cheap? Would you buy at current prices? That's the question. Flight Centre, we started buying at $18. We made very good gains, but will we buy it at 47, 48? That's the question. So a good business, but it's probably very much expensive, and so is a lot of healthcare companies out there.
Well, that leads me to that old market axiom that I learnt in my early days was, if you can't buy it, you got to sell it, and if you can't sell it, you got to buy it. So it looks like we're probably somewhere in between there. All right, we're going to take a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with our panel, our lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au.